everything's at its all-time high. Inflation's not falling fast, and they're cutting rates. The trend followers are 95% long. What does that say about everybody else that they're following? July was the first time in 25 years of doing this that every little single thing that I looked at told me to sell. This is a time to, at a minimum, have cash on the sideline. This is the type of an environment in which you could have a pretty strong drawdown pretty quickly.
This episode is brought to you by VanEck Semiconductor ETFs. You'll hear more about the VanEck Semiconductor ETF, ticker SMH, the largest semiconductor ETF, and its newer VanEck Fabless Semiconductor ETF, ticker SMHX, later in the show. The Blockworks Digital Asset Summit, crypto's premier institutional event, is back in London this October 13th to 15th. You've got top speakers from BlackRock, Circle, Coinbase, the UK Parliament, and Athena, all under one roof. I'll be there as well, hosting a live forward guidance episode with Quinn and a few others. So if you want to see us record in the flesh or meet some of the other legends from the forward guidance community, this is your shot. Notable macro names like Michael Howell of Cross Border Capital and Jeff Park are already confirmed, with more coming. There's also a VIP dinner on the 13th that will sell out fast. That's for speakers and VIP ticket holders only. It's at Old Billingsgate in London. Use code FORWARD100 for £100 off. See you there. Nothing said on forward guidance is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice, or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed.
All right, folks, welcome to another episode of Forward Guidance, the weekly Roundup edition. It's August 14th, Thursday, recording after the close. A little bit of the inmates running the asylum this week with Tyler and I, as Felix is out this week. So in his place is Brent Johnson, who'll be joining us. Brent, great to have you, and feel free to give a little intro.
Sure. Thanks for having me. I'm excited to be here. I haven't talked to you guys in a while.
We brought the ringer in because Felix is a dead weight.
The funny thing is I'm gonna embarrass Tyler a little bit.
Yes.
So it was probably 10 years ago. I was at work and I don't remember if it was a text message or an email, and it was somebody saying, hey, they I don't know if they'd seen a presentation or something, but wanted to get together for coffee or something. So we got together, and it was Tyler, and we're talking, and we were living in San Francisco, and he asked me where I lived in San Francisco, and I said I live up on Nob Hill, and he said, "Oh, I live on Nob Hill," and he said, "Yeah, I live just north of Grace Cathedral," and I said, "Well, I live just north of Grace Cathedral." And we literally lived right across the street from each other. Like, the fact that we had not bumped into each other already was kind of wild. So anyway, that's how we got to be friends.
And then I'll take it one further. So I, obviously, like, Brent was on like one of the very first episodes of Real Vision, and he was I forget, he was talking about the gold market back then, and it's now coming to fruition like 10 years later. But
It took a while.
But I was always a gold bug at the time, and always interested in stores of value. And so I reached out to Brent cold, and I was like, "Hey, you're in San Francisco," and I grabbed a coffee with him, and I think Brent's wife was like, "You think that guy's gay? He's reaching out to you for a date?" Single guy in San Francisco, like, he's like, it's a power of 3 kids.
It's a good thing you didn't have that haircut at the time. He probably would have never called you back.
Oh yeah, no chance. Look at this. Yeah, I got the skin fade. I asked him to just get it close because it's like 100 degrees here in Texas.
Did the power go out? Was he doing it in the dark?
Yeah, he was blind actually. So.
We got to take every opportunity we can to roast Tyler because we know he's doing it.
My wife, I came home. My wife goes, "Good God!"
I love that. Well, good stuff, guys. We got a decent amount to cover. We're gonna get into some of the economic data from the week, some of the other headlines, news, and then talk market views while we have Brent get his takes. And so maybe to start out, we can just run through a couple slides here on the recent inflation data, as we had both CPI and PPI this week. CPI came in kind of largely in line, although relative to today's PPI, not nearly as surprising or frightening, but it is showing some signs of, I would say, like perkiness. It's always difficult in these moments to assess whether it's, just kind of the top of the downtrend range or actually, breaking out to kind of be reaccelerating. Probably the most interesting takeaways were in relation to the mix of goods and services. So the big development this week, which Anna Wong from Bloomberg had a really good preview on, saying that the tariff-related goods inflation would be subsiding relative to most people's expectations in previous months. Mike Ashton, the inflation guy, he has some good charts here that show that as well. However, it is still running above 1%. So core goods is running above 1%. And the big surprise this week was services in both the CPI and PPI. So we saw data that basically showed, while everyone was focused on the tariff side of things, sort of a reacceleration and at minimum a firming of inflation. That's what these charts here show. Month-on-month core CPI highest since January of the year. And some potential leading indicators with ISM services, showing the way for CPI reacceleration. The other big thing was the sort of median level within the CPI prints, which is elevated above 0.25% month over month. And then this kind of concept of like the average component. We have a rising percentage, growing percentage for the average component. So kind of wrapping that up was headline like okay, but underneath the hood, some potential causes for concern. Inflation expectations are still at like 3 to 3.4 for the next few years. So it's not that this was that surprising to the market, I would say, and that's probably why you've seen equities not fall out of bed. But the end result is that there's still 89% chance of September, and market's still pretty firmly in the 2 cuts camp by the end of the year. So we put this meme in there because Trump wasn't going to like the PPI numbers today. So we figured there'd be a headline. No headline yet, I don't think. So but
I was busy all day. I was busy all day. I don't know if Trump said anything or not, but I was ready for him to.
Yeah, there's so many good memes and stuff on Twitter. Maybe we'll start with you, Brent. What your overall take is on it, and if you want to morph that into kind of broader market views, that's cool too.
Well, for me, I kind of have the same view of inflation that I do with interest rates, and probably rightly so, because one kind of reflects the other. But I'm of the opinion that it's somewhat nuanced. I feel like most people I talk to were either heading into hyperinflation and assets are going to the moon, or we're heading into the Great Depression and everything's going to collapse. And there's not a whole lot of middle ground, and I find myself very much in the middle ground. I expect markets to be higher over the next couple of years, but I don't think it's going to be a straight line, and I think it's going to be very volatile. And I don't think interest rates and inflation are coming down very much unless they crash lower. So, if there is some kind of a market event or economic event that causes markets to crash and therefore take prices and economic growth with it, then I think we could see lower inflation. But I am not expecting, just a slow drip lower, from 3.5 to 1.5% inflation, and a stair step lower of interest rates from, call it 4.5 to 2.5 or whatever it is. I think they pretty much stay where they're at or go higher unless they crash lower. Now I'm not playing the crash lower, but that's kind of my outlook. And I feel like the data kind of supports that. In other words, to a certain extent, we've had this Goldilocks, all summer on the inflation data. It hasn't been too hot, but it hasn't been weak either, right? But the expectation that rate cuts are coming has depressed volatility and pushed asset prices higher. But I don't see why prices are going to just slowly go down unless they crash. I can come up with a number of reasons why they would crash lower. But I just don't see it happening in the data yet. And with tariffs just now actually coming into being, I think that has the potential to at least keep them at elevated rates, even if they don't take off and go higher. And I think Powell is in no hurry to cut. And I know everybody's expecting him to cut, and I won't be surprised if he cuts, but I won't be surprised if he doesn't cut either. I think there is a lot of personalities at play here. I think the last thing in the world he wants to be is Arthur Burns. Now, that's not some great insight on my part. That's been discussed ad nauseum over the last couple of years, but I think it's right. But I will say Trump has done a masterful job. And listen, whatever you think of Trump, he is a great master of the narrative. And he has done a fantastic job of setting up Powell as the fall guy if there is a correction. Because if he cuts and if he doesn't cut and the market goes down, he says, well, stupid Powell, I've been saying all along, he got it wrong again. If it wasn't for him, markets would be higher. But if he cuts and markets go down, he says, stupid Powell, he was late. I've been telling him for 6 months he needed to cut rates. And now he's like, no matter what happens, Trump is covered. And while the Trump haters will say it's Trump's fault, the people who voted for Trump, they're going to eat it up. And the populist rhetoric of the evil Fed, Powell's hurting your 401ks and your IRAs. At the same time, he's building a $2.5 billion palace in Washington, D.C. That is going to sell to his base. And so, and the ironic thing about all this is I actually think Trump would be okay with a correction. I don't think he is as against it as many people think. I know I'm not saying he wants it, but I don't think he's going to freak out if there's a 10% correction in the stock market. I don't think Besant would be all that upset with a 10% correction in the stock market. Markets don't go up straight and to the right. There are going to be corrections. And I think they would, if there's going to be one, I think they would much rather have it now than 9 months from now or 12 months from now heading into the midterms. So that's kind of a long-winded answer to your question, but that's kind of where I see the inflation expectations at right now.
Breakthroughs begin with semiconductors. With over $23 billion in assets under management, the VanEck Semiconductor ETF, ticker SMH, is not only the largest semiconductor ETF, but it has also outperformed the next largest semiconductor ETF. It is built on an intelligently designed and constrained index that includes the whole sector stack, from design to manufacturing. Historically, this unique construction and methodology have helped SMH outperform its closest ETF competitor. Check out the table below. Go to vaneck.com/SMHFelix to learn more. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
What's a quote? Never let a good crisis go to waste.
Right.
Or, you got Besant out there talking about short-term rates being 1.5 to 2.5% in the future. I think that was on Fox News yesterday, which is just incredible. So they're basically putting the blame squarely on Powell if he doesn't ease. And
well, not only that, Tyler, think about all the stuff that both Trump and Besant have said over the last couple months. Is they've done a horrible job. They're behind the curve. They need a full review. We think the Fed needs a full review. And I've been talking about this for a couple of years now. I think we're moving towards a period where the functions of the Treasury and the Fed get merged. Now, whether that's official or whether it's unofficial or whether the Fed just gets less autonomy and the Treasury gets more control or more say on monetary policy. Not to mention the fact that, it kind of started under Yellen, is that you could argue that Treasury has started doing monetary policy anyway. Traditionally, Treasury is in charge of dollar policy and the Fed's in charge of monetary policy. But, those lines have gotten blurred a lot over the last couple of years. And again, if there is some kind of a downturn, or if there is something that doesn't go perfectly, Trump and Besant have both set it up to where they're not the ones at fault.
The other ironic thing is that if they actually did cut 150 basis points, like Besant's saying, is, you'd have way bigger issues in the long-ended mortgage market than today. But everybody, when you talk to people, they don't understand the nuance between front and back end, and everyone just thinks that Powell kind of controls the mortgage rate.
Okay, so this is another part of the reason I think we're due for a correction. Again, I don't think not necessarily a crisis, just a correction. Is that I'm not convinced that if they do cut, it's necessarily going to be welcomed by the market. It might be, and I'm not. Again, there's nuance here, right? I'm not saying that it's guaranteed that they cut and all of a sudden bad things happen. But if they're cutting, gold's at its all-time high, Bitcoin's at its all-time high, real estate's at its all-time, stocks are at their all-time high. Everything's at its all-time high. Inflation's not falling fast, and they're cutting rates.
This is
So there's two parts to this. Okay, why are they cutting? What do they see that we don't see? If they're cutting with everything at its all-time high, what do they see that we don't see? That's number one. But then the other thing is if they cut short ends, to your point, Quinn, if they cut short rates by 50 basis points or whatever it is, does the long end necessarily come down with it, or does it jump? Because, and does that accomplish, and does that counteract the whole point of why Bessent and Trump want the cuts to begin with? I'm not convinced that a cut benefits Trump and Bessent the way they think it does.
That's a fair point. Yeah. I'm curious. So can I hit you with a couple of slides and see your thoughts on them? Because I think we're heading in the same direction here, which is, if you hit 39, basically what's happened is because the narrative has been massaged, and whether Trump actually gets his way and gets Powell to ease, or regardless gets him out of there, this is what's happened. This is the move index, and it's at all-time lows. So bond volatility is at all-time lows. They've messaged it because September odds of easing are was it 90%? Maybe not 90% after today, after the PPI, but still pretty high for September. Then go to the next slide, Quinn. This is options realized vol on equities. So this is 10-day realized volatility is below 10 for the first time, which is also causing those systematic VAR, equity players to lever up their books on the equity side. So the VIX is really low, and we've just seen, even today after the PPI happened, you had a brief pop in the VIX, and then the VIX just got hammered. Absolutely. Yep. Obviously, it's part seasonal because there's not much going on in August and everyone's on vacation. And then the next slide is high yield credit spreads, super, super tight. This goes without saying, but I think this is why you're seeing money flee to the frontier markets, the ARKK markets, crypto, gold's kind of in there, I guess, now too, as a new source of collateral. But a lot of the really frothy stuff, altcoins we're kind of going to, and that all leads us to the last chart, which is the Goldman Sachs Financial Condition Index. Is they've messaged this thing, like to your point, where if you ease, what happens now? Like, if you got to do 50 to really like have an effect, I think, with where the market is and really get risk assets moving. Otherwise, I'm of the cases like we've seen a pretty big move. I think it could probably still keep going just given its next 2 weeks, but I'm with you where I'm getting a little nervous that, given where all the assets are, it's time for a little correction. But what are your thoughts?
Well, so if you go to slide 62, so 62, it's a chart of 2022, and I had 2022 as my analog for 2025. Starting back in like November. And the reason is I thought we were going to have to deal with a paradigm shift in 2025, the same way we had to deal with a paradigm shift in 2022. And I thought, in 2022, it was interest rates, and now it is tariffs. But in many ways, you could argue that tariffs have a similar effect on markets as rate hikes, right? And so I thought there was going to be some similarities. And so I wasn't surprised at all by the drawdown into April, and I wasn't surprised at all by the rebound up into, let's call it late May, early June. I have been surprised that we have not, long story short, I thought we were going to start rolling back. Again, not necessarily a crash, but just I thought we were going to start giving up some of the rally, late May, early June. And it just hasn't happened. So I felt like I was very right from the beginning of the year to the end of May. And I felt like I've been very wrong for the last 8 weeks as it's just continued higher. But the point here that I'm trying to make is that asset markets don't move in a straight line. Now, this was a 9-month period, and then after that, the market went on a tear higher. It wouldn't take a whole lot even if the market had a 10% correction here or a 15% correction, the market's still up dramatically, right? And I just I don't think markets go up straight and to the right forever. And so and I think the fact that tariffs got kicked down the road and now they're back, and over the next couple of months, we're going to start at least seeing some of the effects of tariffs. Now, I don't think they're as apocalyptic as many people that seem to think these tariffs are, but we will see some effects. And so when I look at the slides that Tyler showed, and I combine that with some of the other slides I have here, this is the CTA's exposure. So CTAs are basically trend following, right? So if the trend followers are 95% long, what does that say about everybody else that they're following? Right? So
I love
right?
that.
They can't be 95% long if everybody else is 70% long.
Yeah.
It just doesn't. So positioning is very extended, right? So let's just go to the next slide. Here's the S&P 500. Now, this is a bit like a 1 or 2 year chart. What I've highlighted, so the top is the price, the middle is relative strength, and the bottom is the stochastics, which is basically just a measure of momentum, right? Relative strength and stochastics are both a measure of momentum. They were both extremely overbought, let's call it 2 or 3 weeks ago. And then we saw that little sell-off at the very end of July into the first week of August. But now since we've seen a bounce in the price and the relative strength is trying to bounce higher, but the momentum is gone. And so that's a divergence, right? Typically, you would want to see them both rising together. The problem is when they both get overbought, they can't rise together much more. And then once the momentum starts to roll down, the way I think of it is like riding a bike up a hill. If you have a bunch of speed and you're pedaling up the hill, you can kind of get to the top of the hill. But if you stop 3/4 of the way up to take a drink of water, it's really hard to start pedaling that bike again and get that same momentum going higher again. Now, it's not impossible. And I'm not saying it. I'm just saying, to me, when you get a divergence in price and momentum, it just makes me start. It's one red flag that I put up. So let's go to the next one. So then, you combine that with the concentration, right? The concentration, again, whether you want to call it the FANG or the Magnificent Seven or the 10 largest, I mean, the market is so concentrated right now that it's basically, a handful of stocks which are really benefiting from the rise of passive management and the way that's changed the market structure. Is pushing those 10 or 20 companies, however you want to define it, 5 to 20 companies are driving the markets higher. I don't have a slide here on the showing it, but part of the reason that this jumps out to me is that there's not only is there a divergence between momentum and price, there's a divergence between the 3 main markets for the US. So the NASDAQ, which is a beneficiary of these 10 largest companies and the big momentum players, has made a new high. The S&P has returned to its high, and this is from late August, right? Or late July. The S&P, I think, is just slightly above its high from late July, but the Dow has not yet made a new high. And that tells me, again, that it's concentrated in those, 10 to 15 names. Let's go to the next slide. And then this shows you where the income of the S&P is coming from. In the income growth is falling. So we're not growing as quickly as we have been over the last couple of years, but it's still being dominated by these 7, companies. And so it just shows how concentrated it is. Let's jump to the next slide. And then here's, just a valuation measurement. We're back to extreme valuations. Now, none of these things on their own are a reason to get apocalyptic and predict 1929 or whatever it is, right? But when you take the VIX, which is at its low, the bond volatility index is at its low, the realized vol is, where that chart showed it is, or, concentration is in a handful of stocks, momentum is starting to fall. And then the reason for the rally, whether it be rate cuts or the removal of tariffs, Well, tariffs are back and they're going to start showing up. And I don't think rate cuts are as certain. And even if they are certain, I don't necessarily think they'll have the impact that everybody. When I put all that together, it tells me that it's not a guarantee that we're going to have a crash. It just says this is the type of an environment in which you could have a pretty strong drawdown pretty quickly. It wouldn't take a whole lot to get a 10% drawdown, especially when you consider the same effects of passive management that can drive the market higher. When it flips, it can drive the market lower very quickly. That's what we saw last July. It's what we saw again in April. And it wouldn't surprise me again if we see it sometime in the next 6 weeks. And then I bring up the next slide. Now, I hesitated to put this in here, but I did it for fun.
Right? This looks like one of Tyler's Twitter slides.
Right? So
Conspiracy.
I typically don't like these because to me, that's just, it's kind of hyperbolic and, they usually don't play out. But again, when everything else is lined up and then you see something like this in my world where I don't just try to make money, I try to protect the capital of the clients I have that have spent a lifetime making it. I at least have to take a step back and say, okay, hold on a second. Right. And the other thing I would say is I've been doing this for 25 years now. Very rarely do I see a confluence of all these signals hitting at once. You'll often see one or two or maybe a handful, but to get 6, 7, 8 signals all lined up at once is pretty rare. A year ago in June or in July was the first time in 25 years of doing this that every little single thing that I looked at told me to sell or to hedge or to be ready for a draw. And that happened, right? Same thing again happened in early this year. Now, I was early this year in January. I saw the same thing start to develop, and it took 6 weeks for it to develop. But then when it hit, it was very dramatic, and kind of the same thing has happened again here over the last 6 to 8 weeks. I was early, and I'm happy to admit I was early. I don't think I'm wrong. Maybe I'll be wrong, but I think I the way I manage money and the way the kind of the model I use tells me this is a time to, at a minimum, have cash on the sideline, some cash on the sideline. You probably want to have a hedge on the positions you have. And if you were ever going to take a shot at making some money on the downside, this is the type of an environment in which you'd want to do it. Now, again, none of these are guarantees. I don't know for sure that this will happen, but that's the way I see things. And when I combine that with the fact that there's a number of potential catalysts that I can identify over the next 6 weeks, and there's always a handful of catalysts that nobody knows about. Those are the black swans that you can't even predict, even if you wanted to. And then the third thing is that for whatever reason, and I would really like somebody to explain to me why, a lot of times whenever you do get these crazy market events, they happen in the fall, sometime between September and November. So it's all of that makes me sit back and just say, okay, this is an environment where at a minimum, I want to be cautious. If you want to take a shot at the downside, this is probably not a horrible time to do it.
Yeah, I agree on the vol side. Yeah, Quinn, where's your head at? I do want to play Contra after Quinn gives us his, because
that's the thing is I can make an argument for the opposite.
Yeah,
I want to say this just so I don't forget to say it. Like after the correction, I'm actually somewhat cautiously optimistic for the next couple of years. I think the things that Trump and Bessent and team are doing could actually have some great positive impact on asset prices. Again, it's not a guarantee, but I could make the case that we're going to go much higher. And I think we ultimately will. I just think we need a pullback.
Using a similar philosophy to SMH, the VanEck Fabless Semiconductor ETF, ticker SMHX, goes even deeper, exclusively investing in fabless semiconductor innovators designing AI infrastructure behind the scenes. We're talking high bandwidth memory, power management chips, custom accelerators, and ultra-fast interconnects, the critical components that make large AI models run faster, smarter, and more efficiently. Go to vaneck.com/SMHXFelix to learn more. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
Yeah, I'm pretty open to that. I thought this article headline summarized the last few months quite perfectly in terms of, you mentioned the narrative that they're able to or have been able to command, to their benefit, really, but this one hit this week where, they've expanded the Fed list to all the governors, all these, which is the most obvious sign of like, all right, drumming up support, trying to make it so it's not just the three candidates who are Team Trump members to be, looser with their monetary policy. And then obviously this meme we had to point out was so good with Zervos being floated and
was he, I didn't see that. Was he floated as a Fed chair?
Yeah.
Oh, I didn't see that.
Must
wow.
be a man outfit. But I think
I actually like that suit. I'd wear that suit.
Yeah, it's snazzy. I think that they've a lot of this benefit has been pulled forward, and I actually agree with your sentiment that like they actually probably don't want things to just be gangbusters yet, and because if the Fed did do what Besson is saying and dropped 150 basis points, the dollar would break lower, inflation expectations would go up, rates would go, yields would go up. It would actually not accomplish anything. So I think they're trying to cushion things in advance of what is also on top of the seasonal things you mentioned. There is some liquidity headwinds hitting. So the reverse repo facility, which has been a huge buffer of liquidity in the markets, and one of the things that's allowed the Treasury to take this active issuance approach and front load duration to the short end and kind of minimize the impact on issuing long duration coupons. It's at the lowest since 2021. And it's basically depleted. It'll be depleted probably by the end of this week. So they still have over 250 billion to refill on the TGA in the next 6 weeks. About that is a pretty meaningful liquidity drain. And so I'm pretty sympathetic as well to the idea of some sort of pullback. The other thing on my mind is that there's been more and more rumblings over the last few days about the BOJ. We had Rakuten, one of the large Japanese firms, saying they're not buying any more bonds until the BOJ hikes. We have Tuesday this week, supposedly there was a headline or something that not a single 10-year JGB traded. And then you have Besant also actually in his Bloomberg interview, which is pretty not normal to be commenting on, other countries, particularly monetary policy, because he's on the fiscal side, saying they need to hike because they're behind the curve, which I thought is a little bit of pot calling the kettle black, because at the same time he's calling for 150 bips of rate cuts here while our inflation problems kind of potentially reaccelerating. So yeah, I'm not so sure on how the rest of the year plays out, but I am cautious here, and I think looking at some of the price action in Bitcoin and other kind of longer tail liquidity risk assets, this week and particularly last 36 hours would potentially line up for some sort of dampening in animal spirits. Positioning is just so long.
Yeah.
Check this out though. Go to slide 46. This is the Russell future. If you actually look at institutional positioning, this is the non-commercial futures position to open interest. This is for the Russell. They've never been more short the Russell, which is really fascinating to me. Where
I think that's probably part of the reason it jumped really hard this week, right? It's a little bit of a short squeeze.
You might get that momentum reversal. It happened, I don't know, 6 months ago where you had tech sell off and IWM just ripped. I think we could probably set up for something like that. But here's what I really want to talk to you guys about. So, Brent, you haven't probably watched these the past couple of months, but I've been going ham on calling this Weimar America, and we're in full Ponzi mode. And when I say that, I mean long term. We all know that the government, just like you said, the Treasury is going to merge with the Fed somehow, one way or another, to finance the government. That will be the policy. Otherwise, that's what happens in history. That's
the point of a central bank. Whatever they teach you in business school, throw it out the window. The point of a central bank is to keep the government in power.
Yeah, exactly. So, and this is probably why you're a gold bull for, God knows how long, and me too at heart. But, slide 43, this is the M2. This is where we go full Ponzi. And this is why I think we're honestly we just keep grinding higher. Is you have buybacks that 80% of the buyback window is open. So even when the VIX pops really quick and the market sells off, you just have that inelastic market of passive and buybacks taking you higher every day. But then you have this M2 money growth. I think it's like 22 trillion of M2. And then if you go to the next slide, this is year over year. M2 money growth, and it's up what, almost 5% year over year. And this is my gauge of, like, if you're talking Michael Howell saying, you know, we're in this liquidity cycle to the upside, I think this is what, you know, crypto is sniffing out right now. And I'm conscious of this whipsaw volatility. If you get a headline or bad earnings from one of the major, you know, components of the S&P or the Qs, I think it's good to protect a little downside here, given the vol so low. But if I look at this from a 20,000 foot view, I just think we're going full Ponzi, crazy land here. And what are your thoughts there? Because, and then this is the last one I just want to show real quick, is slide 47 to end, because I think you'll love this. This is why I think they're going to lower rates massively. The real estate to S&P. This is how bad. I've been talking about this on Twitter a lot, but there's a commercial real estate crisis going on there. There's this guy, Nightingale, this guy, Twitter, he talks about this building in, I believe it was San Francisco, took an 86% haircut. Giant, you know, it was like a $500 million building. And that's supposed to be your short volatility pension asset that you buy for life insurance companies, and it just resets at, you know, 86% lower. And we're seeing the real estate sector just get absolutely annihilated. And to me, that I'm like, okay, this is like when you print ungodly amounts, especially with Trump at the helm, and he knows how bad commercial real estate is. If your peer buildings are taking, you know, 86% haircuts, 70% haircuts in major metropolitan areas, I think they're just good. Even if Powell stays pat for this September meeting, he's gonzo. There'll be something that happens.
Yeah, no, it's. I agree with you. One thing, go back to the M2 slide.
Yeah,
because I think this is important to point out for people who aren't quite familiar. Yeah, that one. So the important thing to remember about M2 is this is not the government printing money. This is the banks printing money. This is the extension, predominantly the extension of credit, right? What the Fed, quote unquote, prints is the monetary base. And they then need the commercial banks to, you know, parlay that into credit extension, which increases M2. And that, you know, as long as credit is, the system has to expand or else it crashes, right? So that's why whenever you see this come down, whenever you see this chart, year over year chart come down, that's when you see interest rate cuts, or that's when you see QE, or you see some kind of government support, because that cannot keep going down without the whole system collapsing. So that's that to me, that's the important part to remember.
This is the annihilating the middle class chart. Like, it's,
yeah, no, absolutely. So
this going up, the middle class is toast.
Yeah. So this is why, for actually a lot of the stuff that you have just said, and I'll piggyback and I'll add on to it, is why I'm actually, you know, somewhat optimistic about asset prices, you know, over the next couple of years in the United States. Because I don't know if I'm sure you guys have seen at some point, either read the book or seen the presentation or heard his recent interviews about it, was when I think it's Richard Werner talking about the princes of the yen, right? The way that Japan had that incredible growth in the 80s was that in the late 70s, early 80s, they kind of quasi-merged the Fed and the Treasury in Japan, right? I think it was called the Ministry of Finance and the Bank of Japan. And the reason that's important is because the Bank of, then together, they would tell the banks, the commercial banks, you need to make this amount of loans to these companies. That's your marching order. Just do it, right? And that is how M2 increases, right? And so when M2 starts increasing, and and it's mandated to increase because of the government. And then you put on top of it the fiscal spending that the government is going to do because they kind of have to do it. And then finally, you put on top of that higher relative rates than the rest of the world. Now, the reason I say higher relative is because rates in the US could come down 200 basis points or 300 basis points and still be fairly attractive to the rest of the world, right? And so if you have higher relative rates, you have window guidance, is what Richard Warner called it, or mandated credit extension, by the commercial banks, and you have fiscal spending by the government, you get into what's called the Imperial Circle, right? And that was popularized by Soros and Druckenmiller, back in I think it was the late 80s, early 90s. They did it in Germany. But the dynamics are still at play. And I would argue that's partly what we've seen in the US over the last couple of years is that, the high rates in the US drew capital in, and, the extension of credit, the M2 picking up despite, higher rates. We've seen an acceleration in M2, and that's very obvious on this chart right here. The question is, can they just push it from here higher, or do we have to have this correction? Again, I think we have to have a correction, but I can't sit here and say for sure that they can't just push this thing higher.
And riddle me this. So you're obviously famous for the dollar milkshake theory. The dollar sucks up all liquidity from the rest of the world. And I really wanted to concentrate on this because I think the world's changed personally. I think we're in a dollar weak environment, and we are now almost like a third world country. We issue bonds on the front end of the curve. We put tariffs on everyone else. The world used to function where we would buy someone else's goods. We'd buy China's goods. They would take those dollars. They would buy our debt. Right now that function doesn't really happen as much anymore. If you see Russia's holdings of treasuries and China's holding of treasuries, they're all dropping. And who is the incremental buyer of the debt, and who's the incremental foreign buyer of US assets here in that dollar milkshake theory, if we are now, essentially going to lower rates and, tariff people? So is that dollar milkshake theory still intact?
I still think it does, but let me address the first part first. Like you said, we could be in a dollar weak environment. We could very well be in a dollar weak environment. I think a lot of people are of the belief that I don't believe the dollar can fall. The dollar can absolutely fall. To me, I don't worry about the dollar falling because the dollar falling typically is associated with asset prices rising. We manage assets. We want assets to rise, right? Crises usually come with the dollar rising. In other words, if you look back over the last 25 or 30 years, you can't find a crisis where the dollar was screaming lower and foreign currencies were rising higher over an extended period of time, because that's just not the way the system works. So if we are in a dollar falling environment, that's fine. But what that does, and I'll try not to make this too long, is it kicks the can down the road, because the only way you get the dollar falling is to have plenty of dollar liquidity. Well, in today's system, dollars are not physically printed. They're loaned into existence. So every time you create a new dollar, you're also creating a dollar plus interest of demand that is going to come piggybacking or boomeranging back 5 years, 10 years, whatever the term of that extension of credit is. And so we could absolutely go into a system or an environment where the dollar, DXY goes from 97 to 90 or 88. We saw this after COVID. It was no problem. Or, asset prices went higher. But you have to remember, it is a relative game. And Europe, if we were to pull up all these charts of Europe, they don't look fantastic in Europe. And what would happen? So if the dollar falls 10% or 15%, that means the euro is going up 10 or 15%. What does that do to Europe's economy, right? What does that do to their budget deficits?
Mm-hmm.
I mean, and the interesting thing here,
I love this game.
And Quinn touched on this. You've got Besant talking about other countries about what they should be doing with their monetary policy. Behind the scenes, this has always happened. the US has always had influence. Now, maybe not 100% influence, and perhaps they couldn't just tell other central banks what to do. But the US has always had influence over foreign monetary policy, treasury policy, all kinds of policies. And to me, this is it bringing out from behind the scenes and just putting it front and center on the stage. In other words, you may have heard me say to use this term, the veil of altruism is being ripped off. For a long time, we pretended that this was a free market and that, laissez-faire and, Adam Smith and, the invisible hand, and that this is the way it should work. But we don't have free markets. And I'll tell you what, in 2022, the yen went from, I think it fell 50% in 6 or 7 months. That does not happen without the Fed letting it happen, or without the Fed or the Treasury branding them currency manipulators. So I'm not saying the Fed said it was okay, or I'm not saying the Fed told them to do it, but that I can guarantee you there were conversations behind the scenes regarding what was going on. And the Fed would have, at least in some form or another, said, okay, it's okay for now, but be careful, right? And so when I see Bessent coming out now and saying this country needs to do this, that country needs to do this, to me it's the same type of thing at work, but it's more overt than it used to be. And for anybody out there saying, well, the U.S. no longer has the power to do this. Okay, really? Well, then why did von der Leyen and Keir Starmer fly to Trump's golf course to meet with him on the, on the trade issue rather than Trump going to them? If Trump has no power, why did they go to him? And then why did they accept the deal that much more favors the U.S. than it favors them? Same thing with Japan, right? And so, again, I'm not saying that the U.S. has perfect control, and I don't know necessarily that the U.S. Is seen the same way that it used to be. I would probably argue that it's not. But on a relative basis, who is stronger? Who has more power, right? And when I think about that, so now coming back to, let's say the dollar goes down, the euro goes higher. What does that do to European exports? And so when their budgets start blowing out, what does the ECB do? I mean, the ECB's been buying Italian bonds for years. So, again, you get back into it, you get back into this relative game. And the other thing I would say is, if we go back to that M2 chart again, the important thing to remember, this is not the action of the central bank alone. This is the action of the central bank plus the commercial bank. If we were just to look at the central bank action and look at the base money, because that's what the Fed quote unquote prints. If you were to look at the base money that's been printed, and then you were to look at a percentage basis of the UK, the EU, France, or not France, Japan, China, they've all, on a percentage basis, increased their monetary base more than the United States over the last 5 years. Or I'm sorry, over the last 25 years. And it's not close. A lot of them have doubled what the U.S. did. So but the point is that then people will say, well, then all fiat's getting debased. Yes, absolutely, all fiat's getting debased. And then it goes to your point. That's why gold's doing well. That's why crypto's doing well. That's why hard assets are a good play, because that will continue. So we gotta bring these up since you're the gold guy. I've got a couple good gold charts for you. This is 51. So this is gold miners, which no one, like, this was hilarious. It's like crypto's on an absolute rally right now, but so are gold miners. This is from Kirill Sokolov. Gold and silver miner ETFs and indices are up 58% and 72% year to date. No one's talking about them. Then it says, despite the powerful fundamentals for gold in the mining stocks and soaring profitability in the miners, it represents one of the most remarkable anomalies we've seen in decades. Shares outstanding of GDX recently fell below 300 million, a new multi-year low. This number declined relentlessly since early 2024 when it topped above 425 million. In other words, despite the strong advance in the gold price since the major breakout in March 2024,
more than twofold advance that GDX share price, investor interest in the gold miners has continued to decline. And then just go to slide 53. This is just to give you a sense. This is a long-term chart. Since 2007, and I think, Brent, I reached out to you gold miners in like 2014?
Yeah, something like that, right?
And I was like, why are they going down? I have no idea. And we were both sitting there at that.
Yeah.
What was that place in Nob Hill, the burger joint?
Yeah. It was either the Nob Hill Cafe or it was at the Big Four, one of the
the Big Four. And I was like, what's going on? We were both like dumbfounded. And now fast forward, and we're literally breaking out from decade. Look at this perfect inverse head and shoulders decade breakout. So what are you seeing there, since you're more of a gold expert?
Well, I gotta say, I'm not participating in the miners right now. It's not that I'm against them. I just feel like they've had a huge run. I don't like buying anything at its all-time high. Now the miners are not at their all-time high, but they're at a whatever 10-year high or whatever it is. Gold's at its. I don't really like anything right now, but on a pullback, then I think you showed that chart where it broke above. If it were to pull back to that support line, and what was used to be resistance was then support, that might be a good chance to take a shot there.
Quinn, where's your head at with all this?
So the forward outlook I agree with Brent that the common narrative and belief is that the Fed's just going to kind of cut and look past inflation no matter what happens. It doesn't, especially when you put that against the backdrop of how accelerated kind of the appreciation in asset prices has been on the back of that. It doesn't make a ton of sense here, the risk reward, to me, because you're expecting it to not be derailed for some reason. And there really is still a decent amount of data to be had before September's Fed meeting. I guess if it's at 90% even after today, people are pretty sold on it. But the idea that the labor market's forcing the hand here, it's not clear to me that cuts are the solution. Although that's why risks rising, because they're treating it as the solution. But we have a labor demand and supply reduction due to immigration and the unemployment rate constant. And so you can really think of that, in my opinion, as sort of a bottleneck. And we're seeing it. I have a good slide here, actually. We're seeing it in some of the data flow through, which is on the wage side. So, you're kind of at this point. This is number of employees, firms planning to increase wages, the blue line. So you're actually at this supply restriction, which reminds me a lot of COVID, where we had a supply chain issue and then a big demand, stimulus that kind of is the reason inflation became problematic. And so when you look at some of this recent data, there actually is a case across some of it to be made that it's still this K-shaped two-speed economy, very much so. But things like this Visa US spending momentum index has increased. I don't know what's behind this. The US federal employment tax receipts data through, it's only 1 week in August, but continues to be very, very strong year-over-year growth. We're seeing that, the daily withheld employment and income taxes, and then this wages, small business optimism rising a bit. So you have this dynamic where, and there's all these weakness factors, but it's going to be really interesting how they handle this, and how I think about it in assets. It's like you have the indices at all-time high valuations, all the concentration factors that Brent mentioned. And so it's sort of bifurcated. It's like, okay, maybe there's one path where they juice, they get the Fed to cut 2-3 times in the next 4 or 5 months. And you're sitting here and you're like, okay, well, we're already priced to perfection in many ways across the indices. So that's why you get the long tail crypto, Bitcoin, et cetera, to kind of fly off, because they're really supporting liquidity heavily. And then you're in this other side of it where, okay, let's say they don't, and it's a little bit disappointing to current expectations. Then you get, asset price correction. So it's this weird kind of this dichotomy of two routes where it's like there's almost, I don't see a great middle ground right now. It's like either they just juice it, and sure, you get a little bit of upside in the indices, but if they're going to actually just full bore liquidity, you'd want to be in the long tails, or you want to be like super cautious and defensive. It's sort of this barbell, how I'm viewing it, because I think inflation is a serious problem, and I just don't see how the current, Fed rate path comes to fruition. Like,
well, so
yeah.
so somewhere related to that, I don't think inflation. I wouldn't say inflation is a problem in the sense that it's going to go much higher, right? I just don't see a compelling reason for it to steadily fall unless it crashes.
Wait,
right?
Let me ask you a question, because at that point, all right, on this AI narrative, I gotta say, I think it actually is bearing fruit. And Quinn, I think you brought this up. The number of unemployed kids out of college, they're not even getting hired.
Oh no, that's
productivity. And we talked about this at Corriente with Mark, who's one of our friends, where he and I thought we were in a productivity boom. I still do. I don't know if it's going to come to fruition in the next couple of months, but over time, over the next couple of years, as AI actually bears fruit, could that have this massive disinflationary, deflationary pressure on prices? And, I kind of am thinking this actually might be something. And one of the policies of the government that's unsaid is they need to win the AI space race. If you look at
100%.
And so that's 100%. Where disinflationary pressures, I think, are coming from, but I don't know where you sit there.
I actually think you're right. I think we could have this productivity boom, but I think it could lead to a lack of, I don't know that, I don't want to say it's going to lead to no jobs, but you can already kind of see it, right?
How scary is that?
Well, this is, again, it's just another thing. And I would say that most people don't think that AI is going to go stair step, but boom, 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 boom. Most people see it as a, exponential, right?
Yeah.
And that goes back to my, if it goes like that, then I could see inflation go like that. But I don't see it just right?
Yeah.
I think it either crashes or it stays at these levels and goes higher.
Yeah.
It's
so bipolar. It's so hard thinking about this. Here's a social question. Your son's what, 15, 16 years old, 17?
Just turned 17, yeah.
17. Okay. Wow. Man, time is flying. Jesus.
Crazy.
Yeah. I think he's 6'7" now or something.
6'6".
Yeah, he could probably beat me up now. Yeah. So what do you do as a father? I've got 3 young kids. How the heck do you prepare your son for this?
So I've been telling him to use AI and figure out how to use it to be better at whatever it is you do, because it's not going away. It's like the whole, you need to spend 18 hours a day studying math because you're not going to have a calculator in your pocket. Well, you know what? You do have a calculator in your pocket.
Yeah.
Right.
So you have Albert Einstein in your pocket.
Right. So rather than, fight against it, I say embrace it, because I don't think it's going away. And I think the people that do well are going to be the ones that can harness the technology as opposed to the ones that fight it. But I 100% agree with you that this gets a little philosophical now, but I actually think it is playing into
the perfect time to get philosophical at the end of the show.
Yeah. So
throw crazy ideas out.
Okay. So, and I just kind of war game all this stuff out. I think to myself, if I'm Trump and I'm Besant, and actually I try to think like Besant, because I think he's probably a little bit more rational than Trump, right? If the market jumps 15% higher over the next 2 months or 3 months, or if it falls 15% over the next 2 or 3 months, which one is better for me? I would almost argue if it falls over 15% over the next 2 or 3 months, that's probably better for me. Because if you just keep going up and to the right, you're bringing in the correction, which will have, again, markets do not go straight up to the right. There will be a pullback at some point. The quicker it happens, right? The last thing you want it is to be next year heading into the midterms, right? So I think of that. And then I think Donald Trump wants 2 things. He wants to be known as the greatest American president, and he wants his face on Mount Rushmore, right? Okay. So, you cannot do that if China surpasses you while you're the president. So he has to keep China in a box, right? He has to keep them from ascending. But the flip side is he doesn't want China to collapse. In other words, he doesn't want a war. He doesn't want a financial crisis. He doesn't want their economy to melt down, because if their economy melts down due to Trump's policies, that doesn't make Trump look like a genius. That doesn't make him look like a great negotiator. It doesn't make him like a great deal maker. It just looks like somebody that caused this big problem. And if China melts down, the United States will go into crisis as well, right? Again, it's not a situation where China goes into a crisis and the United States is having a picnic. I mean, the markets are interconnected, right? And so what Trump has to do is he has to keep them from rising above him, but he also has to keep them from going into a bigger deflationary spiral than they already are. I mean, China is really struggling with deflation right now. And that's not easy to do. And again, I think but the sooner that the tough stuff happens, I think the better it is for him to then implement all of this stuff, that you're talking about, that really do goose the market from a now a little bit lower base. And for the U.S. to maintain its hegemony, it has to win the technology race. It has to, because if China wins that, then they will supersede the United States, and that won't be good. That won't be good for Trump. It won't be good for the administration. It won't be good for the United States as a whole.
Then Quinn, where is your head at generationally? You're 10 years behind me, I think. And what's the vibe in your cohort on monetary policy, et cetera? Where, obviously this K-shaped economy affects you if you don't own a house or you never locked in your mortgage at 3%. So where is everyone there?
I'm low 30s. I would say everyone's sort of having the realization, in most of these cities, it's 2 plus times your monthly payment to buy versus rent. Like if I want to buy my place, I'm putting a down payment plus, paying 2.2x or so a month more. So that just shows how unaffordable, and because of the elevated financing costs to buy. And I think a lot of our generation is having this realization, they're turning 30s, they're getting married, and they're like, okay, I kind of need to start having kids now, but I've been living in this apartment in a city that's actually, if I wanted to buy it, I cannot even think of affording it. So I either have to like massively downsize, doesn't work if you're expanding family, or move to Phoenix, move to like some of these other areas.
Or go long altcoins, right?
Yeah. Or gamble. And that's the gamble, I guess, phenomenon here is people are saying like, well, I can just gamble it or, and swing for the fence. So I think the AI space race thing is real. And I believe all of that. But what I don't think people account for is that, Jem Carson talks about it, and I actually agree with him on it, which is you run into the social dilemma. Like I can want to win the space race. I can want to do this and that. But when you have, when you're seeing youth unemployment go above 10%, right? Like these are like emerging market numbers outside of a recession. I mean, you're basically, it's indicative that this part of the economy is effectively in a recession. And so it's not all roses when those sorts of social dynamics happen. And then that's when you get the, New York mayors and the AOCs and then their policy that'll put a kibosh to these things pretty quick. So I do, I think it's touchy from here in terms of like, and that's assuming, right, all the power needs of it is met. And there's no question AI is going to be a massive player in the future. But I think you have to be more creative about where you're expressing that view today than, other times, better valuations.
Yeah.
What we haven't really talked about yet, Tyler, is stable coins.
Yeah.
And I actually think that is a huge, I think it's a much bigger deal than people realize.
Yeah.
Not because I think it's necessarily a way for the U.S. to keep running these budget deficits and have a new buyer. I think it'll help that a little bit, but to me, that's not the real power. The real power to me is that it's the U.S. creating its own channel that it can control that could eventually become the Eurodollar rails, right? Or the Eurodollar plumbing. And that would give the United States more control over global monetary policy. They already have more control than anybody else, but they don't have full control, right? But it would give them more control than they have now. And I kind of think of it like when they transferred LIBOR over to SOFR, right? Took 4 or 5 years, but they finally did it. And now the U.S. has control of SOFR, you know, and LIBOR no longer exists. I could see the same thing happening with stable coins. But this is all part, to me, this is all part of, and people aren't going to like me saying this, but I'm going to say it anyway. This is unfortunately the fall of the American Republic, but it's the rise of the American Empire. And I'm increasingly coming to the, not a conclusion, because I still think about it a lot. I don't know for sure, but I'm increasingly thinking that the next four, you know, the 4 turnings, going through the 4th turning, then we get the spring. That whole next cycle could be one where it's not characterized by more freedom and more decentralization, but unfortunately more centralization and less freedom. And I don't necessarily like that, but I think that seems increasingly likely to me in a world where, you know, countries are fighting over resources. Everybody's dealing with debt problems. Everybody's dealing with demographic issues. The likelihood that governments are going to step back and not try to solve these crises or solve these big challenges, I think is naive. I think they will try to impose their will and the way they want things to be done, as opposed to just letting them work themselves out on their own.
Yeah, markets are now a political utility for sure.
Totally, absolutely. And I think you don't have to like it, but I think accepting that and understanding that is going to be hugely important for the success of portfolios in the years ahead.
Well,
Good stuff.
yeah.
Thanks a lot for, we'll cap it there, running over an hour. But Brent, thanks a lot for joining us. And
yeah, thanks for having me.
August
Cool.
slog.
Thanks, Kyler.
Summer slow. Everyone stay cool out there.
Yeah.
Bye, guys.
Don't get a haircut like me. When you're eating airline and you're in mid-40s, stay away from this.
Love it. Good stuff.
All
See
right,
you
man.
guys.
See you guys.